I'm ready for the backlash on this one, but somebody has to say it out loud. Real estate is not the gold mine you were promised. I'm not saying property is worthless. I'm not saying your rental is about to collapse. I'm saying the story we were all sold, buy the house, buy the duplex, buy the fourplex, sit back and let equity build itself, that story was written for a different interest rate environment, a different regulatory environment, and a different version of the banking system than the one we're operating in right now. And here's the part almost nobody knows. Right now, there's a lending market worth somewhere between $1.5 and $2 trillion, operating almost entirely outside the banks you grew up trusting. And most people watching this video have never even heard its name. So here's my confession. I've been quietly moving a piece of my own capital out of physical property and into exactly that market, private credit, direct lending, the part of the financial system that used to belong exclusively to banks and now doesn't. Before you close this tab, I want your honest reaction in the comments. Is real estate still the foundation you'd build on, or do you think the entire premise is out of date? I actually read every one of these. Tell me where you land. If you're new here, welcome. I'm Dr. Ben, and this is WealthForge. This channel was never built to give you another hot take on the stock market or another buy this, sell that prediction. That's not architecture. That's noise. And there's enough noise on the internet already. What we do here is different. We don't follow the market. We design the moat. In a world of followers, we are the architects of our own freedom. That's not a slogan I say because it sounds good. It's the actual filter every video on this channel has to pass through. Are we building something structural? Something with walls, with a foundation, with a roof over it? Or are we just reacting to whatever the headlines are panicking about this week? Today, we're building. So let's get into it. Let's start with why real estate earned its reputation in the first place, because the reputation was earned. For decades, a mortgage was one of the only tools available to an ordinary person that let them control an appreciating asset using someone else's money. Leverage, a hedge against inflation, a forced savings account in the form of principal paydown. Real estate did all of that, and for a lot of people, it still does. But here's what's changed underneath the floorboards. Financing costs are no longer a rounding error. When your mortgage rate was 3%, the math on leverage was forgiving. Almost any property in almost any condition could be made to cash flow, or at least break even, while you waited for appreciation to do the heavy lifting. That environment is gone. Now, every dollar of leverage has to justify itself against a much higher cost of capital, and a lot of deals that used to pencil out on the back of a napkin simply don't anymore. Then there's the part nobody puts in the brochure. Real estate is operational. You're not just holding an asset, you're running a small business. Tenants, vacancies, maintenance calls, insurance premiums that seem to double every renewal, property taxes that get reassessed right after you've done the renovation that finally made the place worth something. I've had that call myself. A pipe bursts at 11 at night. The tenant is furious, and suddenly the passive income you were promised is the least passive thing in your week. A furnace fails in January. A roof needs replacing after a storm nobody budgeted for. A tenant stops paying, and the process to resolve it takes months you didn't plan for. Every one of those events is a phone call that lands on your desk, not a line item quietly working in the background while you sleep. None of that is a criticism of real estate as an asset class. It's just an honest accounting of what the asset actually demands of the person who owns it, in time and attention as much as in capital. And then there's concentration. For most people, real estate isn't one piece of a diversified structure. It's the whole structure. Their primary residence, maybe a rental or two, and that's the entire wealth plan. One illiquid, undiversified, heavily leveraged position sitting in a single geographic market, exposed to a single local economy, a single employer base, a single set of local zoning decisions you have no say in. If that market turns, there's no quick way out. You can't sell 10% of a duplex to raise cash for an emergency. You either sell all of it on somebody else's timeline and somebody else's price, or you don't sell at all. Compare that to a portfolio built from pieces that each can be sized, adjusted, and rebalanced independently. That flexibility is worth something, even if nobody puts a number on it in the listing. So the question isn't, is real estate bad? The question an architect actually asks is different. Is a single illiquid asset class, financed entirely with debt in one location, still an intelligent foundation to build an entire structure on? Or is it time to add a second material to the blueprint? This is where private credit enters the picture. Stay with me for the next couple of minutes, because I know regulation isn't exciting, but this is the part that actually explains why your parents' real estate playbook doesn't run the same way anymore. Here's the short version first. Banks used to make these loans. New rules made it expensive for banks to keep making these loans, so somebody else stepped in. That's the whole story. Now let's look at why. After the 2008 financial crisis, regulators tightened the rules banks have to follow when they lend. Frameworks like Basel III, domestic reforms like Dodd-Frank here in the United States. Banks suddenly had to hold far more capital against riskier loans. Picture it like a landlord being told they now need 3 times the security deposit for the exact same tenant. The loan didn't get riskier overnight. The cost of holding it did. That hit one category hardest, lending to mid-sized businesses too small to issue public bonds and too small to line up a broadly syndicated loan. Banks pulled back from exactly that segment, not because the demand disappeared, because the regulatory cost of supplying it from a bank's own balance sheet went up. Somebody had to fill that gap. Non-bank lenders, private credit funds, stepped into the space banks were vacating, and they've been growing ever since. First as a niche corner of what people used to call shadow banking, now as a mainstream pillar of corporate finance, sitting right alongside the public bond market and the traditional bank loan market. We're not talking about some fringe corner of finance anymore. Multiple industry researchers and credit analysts now put private credit somewhere in the range of $1.5 to $2 trillion, having roughly tripled in size over the last several years, with continued growth projected out towards the end of the decade. That's an entire parallel lending system that grew up in the last decade and a half, largely invisible to the average investor, because nobody teaches this in school and nobody advertises it on a billboard.
Here's the structural piece I want you to actually understand, not just nod along to. When a private credit fund makes a loan, that loan usually sits senior in the capital structure, meaning if something goes wrong with the borrower, the lender gets paid before the equity holders do. Many of these loans carry floating interest rates, which means the income adjusts as rates move, instead of being locked into a fixed number that inflation can quietly erode over a decade. And the loan has a defined maturity, a contractual date by which the principal is supposed to come back to the lender. Compare that to owning a piece of property with no fixed return date, no contractual payment schedule, and a return that depends entirely on somebody else wanting to buy it from you someday at a price you like. That's the moat. Not real estate versus private credit as some kind of boxing match. It's recognizing that a contractual, senior income-producing position can sit right next to your existing real estate holdings and do a job real estate structurally cannot do. Produce a defined, negotiated return without you ever having to fix a leaking faucet. Now let's talk about how an ordinary architect, not a pension fund, not a family office, actually gets access to this world. Because for a long time, this truly was locked behind a velvet rope reserved for institutions. The most accessible entry point most people can research today is the Business Development Company, or BDC. A BDC is a company, often publicly traded right on a stock exchange, that's regulated by the SEC specifically to lend to and invest in private and middle market businesses. Because many BDCs trade like a normal stock, you can look up their holdings, their historical income distributions, their default to non-accrual dates, all in a public filing, the same way you'd research any other company before buying its shares. The next layer is the interval fund and other semi-liquid structures, closed-end vehicles that periodically allow investors to redeem a portion of their shares on a quarterly or similar schedule, rather than offering the daily liquidity you get with a stock or mutual fund. These structures have become one of the primary ways private wealth is now flowing into direct lending, to the point where industry research now estimates semi-liquid vehicles account for close to a third of the entire direct lending market flowing through the wealth channel. That's an enormous shift in who gets to participate in this asset class, and it happened quietly over just the last several years. And then there are the more traditional private funds, the ones that typically require you to qualify as an accredited investor, meaning you meet certain income or net worth thresholds defined by securities regulators, precisely because these structures carry longer lockups and less transparency than a publicly traded BDC. Notice what I'm doing here. I'm not telling you to wire money into the first product that shows up in your inbox. I'm giving you the actual vocabulary: BDC, interval fund, accredited investor, so that when you go do your own research or sit down with your own financial professional, you're not walking in blind. That's the entire purpose of this channel. Architects read the blueprint before they sign anything. It's also worth knowing that private credit itself isn't one single material. It's a whole category. Direct lending to middle-market businesses is still the largest piece of it, but there's also asset-based finance, where loans are secured against a specific pool of assets rather than a general business cash flow, and specialty finance, which covers narrower, more specialized lending niches. Some of the fastest growth in private credit over the last year has actually come from those newer, more specialized corners, rather than from traditional direct lending alone. You don't need to master every subcategory before you start. You just need to know the category exists, so a fund manager can't hand you a single strategy and call it the whole picture. Because I also need to be straight with you about the risk side of this ledger. A moat that's built on incomplete information isn't a moat. It's a liability wearing a disguise. Private credit is illiquid by design. Many of these structures do not let you exit whenever you feel like it. Interval funds cap redemptions. Traditional private funds can lock your capital up for years. If you need that money back on short notice, this is the wrong tool for that job, full stop. There's also credit risk, plainly stated. These are loans to businesses, and businesses sometimes fail to pay. Headline default rates across the industry have generally been reported in the low single digits in recent years, but industry researchers have also pointed out that once you account for restructured or renegotiated loans, the real stress in the system tends to run higher than the headline number suggests. And unlike a bank deposit, capital in a private credit fund carries no government insurance behind it. If the underlying loans underperform, that loss is yours. There's manager risk, too. The entire model depends on whoever is underwriting these loans, their discipline, their sector expertise, their willingness to say no to a bad deal. A mediocre manager in this space isn't a mediocre outcome, it's a real one. And this asset class is cyclical. Entering 2026, credit analysts across several major institutions have flagged a more cautious environment than a few years ago. A handful of high-profile defaults late last year, looser lending standards on some newer deals, and closer regulatory attention on the sector as retail and insurance capital keep flowing in. None of that means the asset class is broken. It means the current environment rewards careful selection over blindly chasing yield, the same way any late-cycle credit environment does. None of that means avoid it. It means treat it exactly like you'd treat any structural material. Understand its load limits before you build on top of it. And I want to be completely transparent with you about something else. Everything I'm walking you through today is education, not personalized financial or legal advice. I don't know your income, your existing debt, your timeline, or your risk tolerance. And anyone on the internet who claims they can give you a specific recommendation without knowing those things is selling you something, not teaching you something. Before you allocate a single dollar into any structure like this, talk to a licensed financial advisor or tax professional who actually knows your full situation, your existing obligations, and what you're actually trying to build toward.
A blueprint only works when it's drawn for the specific building you're putting up, not a generic one borrowed from somebody else's plot of land. So here's how I'd actually frame the blueprint if I were sitting across the table from you. Real estate isn't dead, and I'd never actually tell you to sell your properties tomorrow morning. What's dead is the assumption that real estate alone constitutes a complete structure. The architects who are thinking clearly right now aren't asking real estate or private credit. They're asking, what does a structure look like that has a contractual, senior income-producing layer sitting alongside its equity and appreciation layer, so the whole building doesn't depend on one material holding up all the weight.
Start small if this is new territory for you. Pull up the public filings on a couple of exchange-traded BDCs and actually read them, not the marketing page, the filing. Look at what sectors they lend to, how concentrated their known book is, what their non-accrual rate has looked like over the last few years, and whether that rate has been trending up or down. If an internal fund is being pitched to you, ask directly what the redemption terms are. What percentage of the fund can be redeemed in any given quarter, and what happens if too many investors ask for their capital back at the same time? That single question filters out an enormous amount of noise. Then, size the position honestly. This is not a place to put money you might need next month, and it's not a place to put your entire structure either. Treat it the way you'd treat any single building material. Useful, load-bearing, but not the only thing holding up the roof. And before any of it becomes real, sit down with a licensed advisor who can look at your full picture and tell you whether this particular material even belongs in your particular structure. Real estate builds your walls. Private credit builds your reinforcement. A real moat needs both, not one standing in for the other. This is what building a moat actually looks like. It's not glamorous. It's not a secret only insiders know. It's slower, more deliberate, and far less exciting than a headline promising you real estate is finished. But it's the difference between reacting to whatever the market throws at you next and designing a structure that holds regardless of what the market does. I want to leave you with the same question I opened with, because I meant it. Is real estate still the foundation you'd build your structure on today? Or do you think the whole premise needs a second material sitting next to it? Put your honest answer in the comments. Agree with me? Disagree with me? Tell me I'm wrong. That's exactly the conversation this channel exists to have. Hit subscribe. If this gave you a piece of the blueprint you didn't have before, you know what to do. Subscribe, drop your take below, and I'll see you in the next one. Because we don't follow the market. We design the moat. In a world of followers, we are the architects of our own freedom.